Ramona, great to see you.
Hi, Pamela. Nice to see you too.
Lovely to have you join us here, and everyone else is joining you here. They can send all of their questions in to you over the next half hour or so. So do go ahead and do that. It's been sort of a fascinating time, as we just outlined there. We know what's going on in the markets. There's been some very interesting concentration stories and others. Ultimately, how have you done in some of these markets? Because it's a bit of a testament to what we've been in. Just tell us a little bit about how things have been going for your fund.
Depends on your starting point, but in recent months, as you introduced, with getting a few inflation prints that were not as expected, and that introduced more uncertainty into rate expectations, which of course introduced more uncertainty to the markets. Uncertainty tends to be where my strategies shine. So the downside protection in my across my strategies really showed up in the last several months. But if you go back, say, the last year, where the glamour or high-flying tech theme was really quite strong, that was great for absolute returns and trickier for relative returns, because that's just not the mandate of a conservative downside protection oriented fund. So those are two time periods for you in terms of how things have been going.
Right, fantastic. The quality, the factors, oh, I just gave away what I was going to say. The factors that you really sort of hold close to your strategy are quality, they're dividends as well, and value as well. I wonder, which one do we get into there first? Because sort of quality has led the day. That's something that you always do. Take us to some of the other factors that we know are always involved in the way that you approach investing.
Yeah, so trying to keep it simple, it's really three things that I want. I want alpha, which is often driven by value, because stocks are all about expectations and value is about low expectations, which are easier to beat than high expectations. And so your alpha odds just go up typically when you've got value on your side. And then I want downside protection and income. So you could sort of tie those to two other factors. One is typically quality for your downside protection. So stability, predictability, and then income is yield. So those are three factors. That would be valuation, quality, and dividends. And then essentially what I'm trying to do is figure out what is the valuation of each one of those. Because ultimately we want returns, and we want returns that are sensitive to risk. So I look very much at the valuation of value, and that has been not as obvious in the last couple of years. So I look at valuation dispersion, how cheap is value? And across my universe, typically of large cap global stocks, that dispersion has been narrow. So I've been needing to go hunt more deeply, more subtly, if you will, across things that are not large cap. So inside of cap, inside of regions, inside of sectors, to find that dispersion within the value factor. And then I look at the valuation of quality as well. So dispersion of quality, and then the valuation of yield, dispersion of yield, to figure out where the hunting ground is. So today there's decent value outside of the US, or decent dispersion outside of the US, lower in cap and in more cyclical sectors. Quality, so if I say free cash flow versus book value, I'm not finding a whole lot of dispersion when I look in there. So percentile dispersions are like in the 50s, which is middling, literally. And then dividend yield has some value in it. So I'm trying to put those together to get us our sort of best risk-adjusted returns, especially in periods of uncertainty.
So can I go back to some of the things you said? There are different places to go hunt. So you mentioned cap size can maybe possibly come down. You also mentioned
Mhm.
regionally. Tell us a bit
Mhm.
more about that and ex-US, because we've been very much focused on how well the economy and many other pillars have held up in the overall story for investment in the US. Why would you look elsewhere at this moment?
So not randomly, the way that I parse it is looking at the world in terms of what we call a valuation superfactor. So I just put a lot of valuation factors together that are very free cash flow heavy. So if you think of valuation factors typically as PE, price to earnings, or price to cash flow, or price to book, let's say those are your three main ones, sometimes price to sales. And if I really want quality, I'm going to overweight, if you will, price to free cash flow or free cash flow yield, especially since I want dividends as well, and dividends are sourced by that cash flow. So if you smush all of those together into sort of like one big valuation factor. And I look at that factor across the world. And then one step further, I look at the most expensive stocks and the cheapest stocks, or most or cheapest to medium, some sort of comparison inside of that. I could then look by any dimension. So typically I'm staying inside of large cap, which is my bread and butter. That hasn't been so interesting in the last couple of years. So I've had to go down in cap. And then when I look at US for that big value super factor versus non-US, there's signal in that. So inside of the US, there's not as much disparity in how stocks are valued. Outside of the US, there's a lot more disparity across sectors. So inside of the US, I can only find that disparity in financials, large cap healthcare, a little bit of energy. Whereas outside of the US, I can find a wider spread between cheap stocks and expensive stocks almost across all sectors. So what that tells me is that if I go, so what you're always trying to do is figure out where's the hunting ground richest, right? Because you only have so many hours in the day. And to me, in my process, I think it's really helpful to use computing power to help make my process, to sort of power my process, if you will. Because if you try to do it sort of in analog or manually or just using human efforts, if you will, without powering it with computers, if you will, or with like quantitative methods is a better.
Are you using AI driven research methods?
Yeah, I mean, AI is the name that we give a lot of things now, but quantitative methods have been around for a long time. Models, you don't really need to overcomplicate things. What I'm trying to say is look across the entire world and figure out where the hunting ground is most fertile is much easier to do when you've got sort of really methodical systems and processes in place. And so that's what I'm essentially trying to describe. So when I've looked at that in the last year, there's just more spread or dispersion or alpha signal outside of the US than inside of the US. And so I've been looking there. I just came back from some travel where I was at a conference where there were like 100 CEOs. So I was able to just meet a wide swath of companies and just get a whole lot more ideas off of this top-down process where you're looking across the world to figure out where the signal is. And then that tells you essentially where to go. So there's more of it outside of the US than there is in the US today. There's some in continental Europe, some in the UK, some in Asia.
Tell us a little bit about the themes that have shifted in, let's say, continental Europe, maybe the UK as well. There has been a shift of, we talk a lot about the fiscal dominance, where governments are spending their money, how it's happening. There's been a shift in a lot of different areas, particularly Europe. Can you comment on that a little bit and maybe how that is a useful investment theme ultimately? What are the Europeans most worried about? It's called a leading question there.
What are they most worried about? I mean, the time frame matters again. I think probably structurally, I can't say. I'm not European. I don't live there. So that's
defense seems to be a big topic right now, right?
Yes, exactly. So I mean,
conference, the defense conference, it seems right now.
Yes, very long term structural economic growth is a big topic. So the U.S. has figured out sort of how to grow. The U.S. has a lot of innovation. And everybody had sort of low rates for a very long time, but in the US, the innovation got mega fueled by those low rates in a way that it didn't quite as much outside of the US and certainly in Europe. So I think there is this long, lingering concern over multiple decades about the sustainable growth rate of continental Europe. So that's long term. Short term, since the Ukraine war, definitely there's been this sentiment shift from, say, energy transition into defense, at least if you're in the markets. I'm not sure if that's true in policy, but in the markets, the market sentiment has shifted very much into what we call the rearmament of Europe after a very long period of not being very defense oriented. So essentially defense budgets structurally are going up, certainly as a percentage of GDP. There's more spending, and that's been one of the biggest contributors to performance in our funds. Our industrials analysts who are in Europe were ahead of this, not necessarily ahead of the idea that Europe should be rearming, but had always been looking at those stocks. So we were prepared when the war broke out. We understood the defense sector in Europe, and we were able to very quickly adapt our forecasts, adapt our models to see that earnings would be sort of multiplying, and that the valuation on that, what we call earnings power, was really cheap, and just buy the heck out of those stocks. So that's been a really helpful part of performance. And at this recent bout of travel that I just did, I met some of the smaller defense companies to try to see if there's any more opportunity in the sector that has been overlooked. So the pure plays have done really well, but some of the more the companies with more mixed business models, where they don't just do defense, they do other things, there's still some interesting valuation opportunity in those. So yes, there's this sentiment shift in the markets from, say, energy transition into defense that probably still has some legs, and that's kind of exciting.
Yeah, that's super interesting, and to sort of hear about it, as you say, from conferences in Europe, and to hear what's being discussed there ultimately. I wonder if we can go to the tech sector for a second. And again, you mentioned again the innovation story, the low interest rate story, the innovation story in the U.S. There's a bit of a catch up probably in the rest of the world. Certainly, U.S. is first mover there, no question. Are there parts of the tech sector that have the sort of dispersion that is attractive to you and to your style of investing?
Um, so 2022 was hard for tech because rates, right? Like high flying tech got super powered again by rates in the last decade, and certainly in the last in the years around COVID. Let's put it that way. And then 2022, there was this expectation of rates going up because of inflation, which really slammed high flying tech. And then we had this recovery in 23 once it was so rates driven. Like once the rates picture there was more stability around expectations. And then that continued into 24, because I think it was late 22 when the AI stuff, ChatGPT and all this stuff came out at the same time that there was greater stability in the expectations of rates. So that's kind of the narrative, if you will, about tech. Since that theme, especially a in a universe like you know like global, where it's a capital appreciation oriented universe, where Nvidia is like 4% of the benchmark, very hard to outrun. Since that theme has been kind of off to the races, the dispersion, to your question, that we've seen in tech in the last 1 to 2 years shows up more in the cyclical parts of tech. So that's what I've been waiting for. So semiconductors, or tech that goes into deeply cyclical end markets like autos or memory. So that would be like NXPI or TEL, right, for autos, or Samsung and Hynix for memory, or TSMC, or even Intel for semis. In my world, where I'm looking for companies with good enough business models and that are generating a lot of free cash flow over the long term, where that free cash flow is being um, overly doubted in the short term, and so you just get some really interesting valuation opportunities. So in that period, when all of tech derated, you were able to buy TSMC anywhere between 10 and 15 times earnings, which is cyclical tech with all of the features that I want for really good. I mean, not today, but for a really good valuation. So that's the kind of dispersion that I look for, especially in high flying tech. There's just not a lot of cash flow definitionally, and therefore you don't have the cash flow to support dividends. So it's just a part of the sector that is out of mandate. So I wait for dispersion in cyclical stuff, and there's some of that today.
That's fascinating. Okay. Also software, is that another area that would be within tech that has some of these dispersions?
There's sort of glamorous software, and then there's software that's seen as maybe more broken. And so I will tend to look, because I can get good valuation in software that's seen as less glamorous or more broken. So yeah, sometimes you can get dispersion in software.
Fantastic. A question rolling in here talking about
Yeah.
the mandates that you manage. Can you speak a little bit about how you manage the equity portion of Tactical High Income Fund versus other mandates that you run? That's the question.
So Tactical High Income Fund just hit our 10-year anniversary. So that's been really exciting. 10 years of yeah, with Adam Kramer and Ford O'Neill, 10 years of really good teamwork and strong performance. The equity piece I don't run particularly differently from the rest of my strategies. So it's meant to bring that same equity income oriented lens into a multi-asset fund. So it's meant to help excuse me, it's meant to help power Adam's process, where he's looking across the cap spectrum. So he's going really wide into every single asset class, using asset class specific portfolio managers to put together his mosaic. And if I'm going really deep inside of income paying equities, then I bring back ideas to him that he can then decide how he puts together in his mosaic for this multi-asset fund. Same thing that Ford does, same thing that Brian Chang does, all of the different fund managers. So what Adam and I are doing all the time is talking about specific ideas that I'm working on for all of my other strategies and whether they would make sense for tactical high income as well. I would say about his process versus mine, Adam is probably more risk seeking in lower risk asset classes.
Okay.
And I am probably less risk seeking in a higher risk asset class. That would be equities. And so when you put us together, it ends up being pretty complementary, if that makes sense. So I think that combination has worked really well over time.
That's fascinating. When you take a look at the macro landscape, and I might sort of add into where you're known for the downside capture as well as a growth and taking a piece of when markets are moving higher, which is most of the time. But in terms of the downside piece of the story here, what would be some of the risks out there that you would point to? Are they macro in nature? Are they geopolitical in nature? Give us a sense of not predictions, but just sort of the things that you're aware of that are there that you may have to just make sure you're positioned in the correct way for it.
So it begins and ends with valuation. And if the market's at anywhere under 15 times earnings, then there's a lot of fear typically already embedded. And obviously you have to contextualize any given valuation level with where interest rates are. But let's assume, kind of today or even lower. So anything under 15 times earnings is pretty interesting and already embeds a decent amount of risk. But once you get closer to 20 times earnings, which is where we are today, you're more vulnerable, I think, to even mild shocks. And that's why the market got choppy in the last few months, because we'd also had this period of really nice market returns getting us to 20, so in some cases higher than 20 times earnings, on the expectation of monetary policy loosening on the back of inflation stabilizing at a lower level. And so when you've got that set up and you get any kind of shock, even if it's a mild shock, you're going to have some choppiness. So you always have to contextualize risk against what's implied. So today, if we're closer to, again, 20 times earnings, I think exogenous shocks like a change in interest rate expectations, which would be on the back of macro factors, or a geopolitical shock, or energy prices, all of this exogenous stuff that we can't predict puts the market in a more vulnerable position. So I'm not necessarily as risk seeking, if you will, as I would be if we were closer to 15 times earnings. Now, it's really hard to get those moments in the market in aggregate, in the interest rate regime that we've been in since the global financial crisis, right? Like rates compressed in this distorted way post GFC, which just really fueled multiples. So you had to really, I think, in your valuation work, had to really consider the role of lower rates post GFC to figure out how to value markets. And so today it's really hard to get 15, but on a company by company basis, stock by stock basis, which is the way that we fundamental bottom up people do it. If I can get interesting valuations that don't need the macro to be one way or the other, that's where I get really excited.
What sectors, and I understand that you're going fundamental company by company, but what sectors don't need to worry about interest rates?
It's relative, right? And it's valuation dependent. So everything, if you look at a correlation of rates, interest rates to returns, and maybe you parse it by defensives versus cyclicals. But even if you just look at the correlation to aggregate over time, you'll see that that correlation has risen and risen and risen post GFC. Like everything got super tweaked in its sensitivity to rates. And it sort of speaks to the distortion in rates coming out of the GFC. And one of the hopes, if you will, of coming out of this inflationary period is more of a normalized, like rates resettle to a more normal place, so you can get markets behaving and markets being valued in a more normal way. Who knows really what will happen? But excuse me, if I can get, like, I'll give you an example. In the UK, you can get a good combination of growth and income. I tend to like the UK for investing because they have this long history of pension funds owning the stocks, and so the companies had to pay dividends, and so the company had to develop a discipline of balancing between dividends and growth, as opposed to one or the other. In the US, it can be very much one or the other. So there's certain parts of the world where you can get this. So in the UK, there are all these interesting companies where I can get a dividend, I get a decent amount of growth. So value retail in the UK has been interesting, or apparel stocks in the UK. There's this company I've tended to mention many times, this footwear company called JD Sports. That's like Foot Locker in the US, but maybe a little bit better, really well run, decent quality metrics, like all the things I look for. That's like 8 times earnings, something crazy. It's very rare to get that. So when something goes under, and I've had this happen enough times in my however long, 20 plus years, when something goes under 10 times earnings, to the extent that you can get enough conviction that the business is not broken, typically it won't be nearly as tweaked to things like rates or wars or oil prices as something that's at 20 times earnings. And that's kind of like the fundamental principle, if you will, in investing, I think, is if you can get a solid enough valuation and do the fundamental work that tells you something's off about that valuation, then you are less susceptible to variables that you can't predict.
Or you have to get your football boots, like, no matter what.
I mean, World Cup, I don't know.
You got to get them regardless if there's terrible things.
Olympics, I don't know. Like, it almost doesn't matter what the business is, right? Like, that's just an example. But for another example is China has been this controversial thing coming out of COVID, this controversial region to invest in coming out of COVID. It hasn't had the recovery that everyone expected, all these issues. And so a lot of Chinese stocks have gotten really, really cheap. And local Chinese stocks are hard for me to invest in because I don't get the quality characteristics that I want. So I don't get the ROE profile that I want and the cash flow generation to support dividends. I just don't get dividends. And so what do? There's a lot of companies in the world that are super tweaked to China. Like, they've got huge businesses in China. They're Western companies. They're pretty high quality. China is not going to break or make them. They pay decent dividends, but their valuations have been impacted by China. Luxury is an example of this. So in the last 2 years, there have been moments where luxury stocks like an LVMH have just gotten really cheap because people are really worried about China. And so to the extent, and when I meet with LVMH and I listen to how they run their business, they're really, really thoughtful. If I can get that stock under, a normal multiple, so call it under 20 times earnings or even under 22 times earnings, that's kind of interesting long term. If you believe there's still urbanization or still wealth generation to be created in various parts of the world, because that's what sort of powers that industry. So there've been these pockets. Value retail in Europe also gets to like 10 times earnings sometimes. So I think just looking around and trying to figure out where the value is can make a difference and help you kind of stay relatively less susceptible to exogenous variables that you can't predict. To me, that's the core to my process.
What would you say is your what is the positioning in terms of ex-US versus US at the end of the day? To give us a sense of where you are.
So my universe is like 55%, 50 to 55% US. It's got a really big US orientation. I historically don't like to be that concentrated in anything. My universe is also 23% tech, because tech has been just so intense, right? So I'm not probably not going to be 25 to 30% tech unless I can get a lot of high quality dividend paying tech. And so there's this portfolio construction thing that you have to do where you're not taking too much concentration risk in any one place.
But you
I
have
tend,
exposure to some of those big names that have done well.
yeah, I certainly do. But even if I love a Taiwan Semi, am I going to make it 10% of my fund? I don't know, not necessarily. To me, for my process, um, there's a certain amount of risk in that you can't get around. There's only so much being an outsider that you can know a company. And so if you're taking that kind of risk, you're introducing a level of volatility into your returns that I just don't have the appetite for because I'm very volatility sensitive. So unless you're okay with really strong volatility in your returns, which I've made a huge argument for in my process not doing, I don't concentrate. So that's concentration. So I'm getting back to your US question. So if US is 55% of the index, I won't necessarily own 60. So I tend to be structurally underweight the US, and my structural underweight is probably bigger now than it is on average, just giving you the buildup.
Well, that's fascinating. And let me see if I can get this question in. This is talking about something that you mentioned off the top, actually, and it was, rich hunting grounds where you're finding some fertile opportunities. So to what extent do you invest in small and mid cap companies, and are there particular advantages in those cap spaces? Because typically you are larger cap, which produces dividends often.
Yeah. So the larger I'm intrinsically large to mega because those are the dominant companies in their spaces. And when you're dominant, you tend to have the highest returns, you gush cash flow. And by gushing cash flow, you can support and sustain and commit to dividends. So that's why we'll skew larger cap. But then you have to think about valuation. And if I've got a lot of valuation dispersion between really big and smaller, then it forces me smaller in order to try to just maintain the alpha characteristics of the funds. And so I've been pushing more into large to mid versus large to mega, if that makes sense, just because I'm finding more interesting valuation smaller, but not necessarily like super small, or not necessarily mid to small, more like mid to large, if that makes sense. Because in mid to small, I will not necessarily get the cash flow characteristics that I want in terms of stability. I will own some of those, but those won't dominate or on average be what you find in these kinds of conservative downside protection funds.
It's wonderful to get an update from you on sort of regionally to understand consumer to what extent, maybe in Europe, and just sort of that theme of rearmament that you're taking a look at in Europe. Lots of new things to bring to investors. Ramona Persaud, thank you for joining us today and for your update.
Nice to see you. See you next time.
Next time, all the best.